Stop thinking Nvidia is just a GPU company. Seriously, if you still believe Nvidia's future depends only on selling chips to hyperscalers, you are about to miss the biggest transformation in the company's history. Here is the counterintuitive truth that Bank of America just laid out. Nvidia is becoming a networking and silicon photonics powerhouse. And nobody is paying attention. BofA just reiterated their buy rating on Nvidia with a $300 price target. The stock is sitting at $214, up 2.9% on the news. But here is what the headlines won't tell you. Nvidia's data center revenue hit $193.7 billion in fiscal year 2026. That's 89% of total revenue. And BofA says the company could generate over $400 billion in free cash flow across 2026 and 2027. That is more than Apple and Microsoft combined. Yet Nvidia trades at a 50% discount to its magnificent 7 peers. Let me break down exactly why. And stay until the end for the 3 secrets that will change how you value every AI stock from now on. I'll admit something. For years I thought Nvidia was a one-trick pony. GPUs for gaming, then GPUs for AI. I missed the bigger picture. Nvidia has been quietly building a full-stack AI infrastructure company. GPUs, networking, silicon photonics, software, everything. Today I'm going to show you exactly what BofA sees that the market is missing. We're going to look at the $300 price target, the $400 billion free cash flow, the Groq 3 LPX launch, the Marvell investment, the networking expansion. By the end, you will understand why BofA says Nvidia is their top sector pick. Stay with me. Let's start with BofA's actual thesis. The price target, $300 per share. The rating, buy. Top sector pick. The valuation basis, 28 times price to earnings, excluding cash, based on 2027 figures. For context, Nvidia's historical PE range is 25 to 56 times, so 28 times is actually conservative by historical standards. The free cash flow story. BofA estimates Nvidia will generate over $400 billion in free cash flow across calendar 2026 and 2027. That is roughly equivalent to the combined free cash flow of Apple and Microsoft over the same period. The valuation gap. Despite this, Nvidia trades at a 50% discount to its magnificent 7 peers on valuation metrics, and at about a 30% lower market cap to free cash flow multiple. The counterintuitive truth: the market is pricing Nvidia like a cyclical hardware company. BofA says it should be priced like a software and infrastructure company. The gap between those two valuations? That is the opportunity. Now let me show you why Nvidia is not just a GPU company anymore. The numbers. In the fourth quarter of fiscal year 2026 alone, Nvidia's data center revenue hit $62.31 billion. Within that, compute was $51.33 billion. Networking was $10.98 billion, up 263% year over year. Networking is growing faster than compute, and it's already a $44 billion annual run rate business. The Groq 3 LPX accelerator. At GTC 2026, Nvidia launched its first non-GPU-centric accelerator system, the Groq 3 LPX. This is built on the Groq LPU, or Language Processing Unit, technology that Nvidia acquired for $20 billion in December 2025. Nvidia claims the Groq 3 will provide 35 times higher throughput per megawatt for trillion-parameter AI models than its Blackwell NVL72. The counterintuitive truth? Nvidia is no longer betting everything on GPUs. They are building a portfolio of AI compute technologies. Inference is disaggregating. Different workloads need different chips. Nvidia wants to sell you all of them. Now let me show you the move that most investors completely missed. Nvidia invested $2 billion in Marvell technology. This is not a small partnership. This is a strategic investment. So, what is the partnership? Marvell will provide custom XPUs and NVLink Fusion compatible scale-up networking. Nvidia will provide Vera CPUs, ConnectX NICs, Bluefield DPUs, NVLink Interconnect, and Spectrum X switches. And most importantly, the companies will collaborate on silicon photonics technology. Why does this matter? AI data centers are hitting physical limits with copper interconnects. Optical connections, silicon photonics, are the future. They are faster, longer distance, lower power. The counterintuitive truth? Nvidia has already invested $2 billion in Lumentum and $2 billion in Coherent for silicon photonics. Now, another $2 billion in Marvell. That is $6 billion invested in networking and optical technology. Nvidia is not waiting for the networking bottleneck to hurt their GPU sales. They are building the solution. Now let me explain why Nvidia trades at a discount despite these numbers. The ownership problem. Nvidia now accounts for about 8.3% of the S&P 500. That is above the prior peaks for Apple at 7.5% and Microsoft at 6.8%. So what does this actually mean? Many institutional investors are already at their maximum allowed position in Nvidia. They simply cannot buy more without breaking their own portfolio rules. And here's the counterintuitive truth. The discount exists because of mechanics, not fundamentals. It's not that institutions don't want to buy more, it's that they can't. BofA's solution? Nvidia could pivot towards shareholder returns with bigger dividends and larger buybacks. Higher cash returns would broaden ownership among dividend and income-focused funds. BofA estimates Nvidia could raise its dividend yield from 0.02% to 0.5% and potentially even to 1%. That would require somewhere between $26 billion and $51 billion in dividends, only about 15 to 30% of projected 2026 free cash flow. The message here is clear. Nvidia has the cash. If they start returning more to shareholders, the valuation gap could close quickly. Let me leave you with the 3 secrets that connect everything we just discussed. Secret number 1. The full stack premium. Most investors value Nvidia as a chip company, but Nvidia is actually becoming a full-stack AI infrastructure company. GPUs, CPUs, networking, silicon photonics, software, everything. Full-stack companies, well, they command higher multiples. And when the market realizes this, the valuation gap will close. Secret number 2, the free cash flow harvest. Nvidia has spent years investing in the AI ecosystem. According to BofA, those investments are largely complete. Nvidia is now entering a harvest phase. We're talking over $400 billion in free cash flow over 2 years. That is not a startup burning cash. That is a mature company printing money. Secret number 3, the ownership ceiling trap. Nvidia's S&P 500 weight is 8.3%. Which is above Apple's peak. Many institutions literally cannot buy more. That creates a temporary ceiling. But when companies start returning cash to shareholders, new classes of investors can enter. Dividend funds, income funds, value funds. The ceiling is not permanent, it's a waiting game. So, what should you actually do with this information? If you are a long-term Nvidia holder, do not panic about the ownership ceiling or the valuation discount. The fundamentals are stronger than ever. Data center revenue is up 75% year over year. Networking is up 263%. Free cash flow is exploding. BofA's $300 target implies about 40% upside from current levels. If you're considering buying Nvidia, the stock is down 16% year-to-date despite the strong fundamentals. BofA says, recent dips could be buying opportunities. If you are worried about competition, AMD, Broadcom, and custom chips from Google and AWS are real threats. But BofA expects Nvidia to maintain more than 70% of AI value share. The moat is real. The question is whether the multiple expands. The counterintuitive truth? The best time to buy Nvidia is when the market treats it like a cyclical hardware company, because eventually the market will realize it's an infrastructure company, and that revaluation could be massive. Here is my question for you. Do you think Nvidia deserves a magnificent 7 multiple, or is the 50% valuation discount justified? Drop your answer in the comments. I read every single one. Like and subscribe if you want more myth-busting analysis on the biggest stocks in AI. I'll see you in the next video.